Hello everyone. The company that I'm going to audit is Fonterra. It is a listed company called Fonterra Cooperative Group Limited. Fonterra is a global dairy nutrition cooperative which sells milk and milk-derived products. Headquarters is based on New Zealand and it is incorporated in New Zealand. There are currently 65 farm source stores under their operation. It also engages in the consumer goods and food services business. According to Financial Markets Conduct Act 2013, Fonterra, as a listed company and insurer on the New Zealand Stock Exchange, needs to be audited. The audit process evaluates the accuracy and reliability of financial statements, reducing the likelihood of errors and employee misappropriation of assets. Potential investors may be willing to accept a lower rate of return on their investment, which means less cost of capital. The audit provides internal benefits of Fonterra. Weaknesses and controls are identified, allowing management to make necessary improvements. Additionally, stakeholders like potential investors, lenders, and customers may also require audited financial statements as part of their due diligence process to ensure the stability and the reliability of Fonterra as a business partner. As for inherent risk, the global uncertainties impact the cost of production and asset valuation. This introduces an inherent risk of misstatement. For example, the value of emission units can fluctuate based on various factors, posing extra risk if their valuation is not accurately determined. The translation of financial statements from group companies with currencies other than New Zealand dollars adds to the complexity. This complexity increases the inherent risk of misstatement, requiring careful attention and evaluation. Furthermore, revenue recognition for transactions involving distributors and assumptions used in impairment tests for intangible assets involve substantial judgments and estimates. In volatile market conditions, forecasting future cash flows becomes challenging, leading to the inherent risk of inaccurate estimations. This can result in overstated asset values or understated impairment changes. As for relevant control risks, the absence of proper separation of duties raises the risk of fraud. Without appropriate cash flow management and regular reviews by directors, one employee may have conflicting responsibilities, leading to higher chances of fraudulent activity. Secondly, weak internal policies in inventory management pose a significant concern. Specifically, the absence of proper internal controls for inventory and year-end expiry product assessment could result in inaccurate data being reported in the financial statements. The impact of IT systems on internal controls cannot be underestimated. Inaccurate computer security creates a risk of data manipulation through a technical backdoor. These raise the possibility of inventory or sales being inflated by personal gain, leading to misleading financial reporting. As for audit implication for inherent risk, we need to carefully evaluate the valuation of assets, particularly the emission units. This may involve gathering information from external sources to assess the reasonableness of the valuation. Then we will perform substantive testing to verify the accuracy of inventory records and evaluate potential impairment or obsolescence risks. Additionally, we will conduct a thorough assessment of the accounting procedures involved in consolidating subsidiaries' financial statements. Lastly, we will scrutinize significant judgments and estimates made by management, which may involve evaluating the historical accuracy of forecasts. Moving on to control risks. By reviewing organizational charts and control documentation, we can identify potential conflicts of interest and ensure proper segregation of duties. Then we will test the implementation of inventory controls, inspect supporting documentation, and assess the effectiveness of valuation methods used. We will carefully evaluate the IT system in place. This includes assessing the effectiveness of IT general controls and application controls related to financial reporting. We will recommend enhancements to mitigate the risk of unauthorized data alteration or fraudulent activities. Based on identified inherent and control risks, it can be concluded that there is a moderate level of risk of material misstatement in Fonterra's financial statements. The global uncertainties and the complexity of accounting procedures increase the risk of misstatement in asset valuation and inventory levels. The inaccurate forecasting can lead to misstated asset values. The overall internal control system is effective. However, the lack of separation of duties, Weak internal policies in inventory management and potential weaknesses in IT systems increase the risk of fraudulent activities. Considering these factors, it is important to gather sufficient audit evidence to mitigate the risk of material misstatement in Fonterra's financial statements.
Thank you for your time.